Good day, everybody. This is Victor Boyage, and I wanted to thank everyone for joining our program today. We should have an excellent discussion, broad-ranging discussion of what's going on in the marketplace, areas of heat in terms of interest in the markets, as well as what's going on in the broader macroeconomic environment that's driving some of those decisions, both at the investor level and the portco level. I'm really delighted to have with me some three strong investors and leaders in the marketplace. Eric Norlander at GV, John Chait at IQT, and Chris Olson at Drive Capital. Maybe what I'll do is ask each of them, Eric, maybe starting with you, to introduce yourselves and really your fund, and we can dive into the conversation soon after that.
Well, first of all, thanks, Victor. Thanks for having me. Great to be with you all. I'm Eric Nordlander. I'm a general partner at Google Ventures. We're Google's VC. We invest from seed to growth across a number of different sectors: consumer, enterprise, life sciences, and frontier technologies. I lead our New York office and invest across enterprise and frontier tech. I've been doing that for 15 years, and my background is as a computer scientist.
John, out of Boston.
So I'm a managing partner at IQT. I help to lead our DC office, but I'm also based in Boston, lead our Boston presence as well. We're a strategic investor operating as a nonprofit, so we are evergreen in terms of our fund structure. We now work with nearly 20 US government agencies in terms of helping to identify new technologies, frontier tech, and basic capability enhancements, as well as we work with some close allies in the UK and Australia. We have global presence, been doing this for 25 years, over 800 investments, and in the US, domestically invested across 35 states, so we have a pretty broad footprint. Our investment activity are in the areas you would imagine. AI today, infrastructure that's there, advanced systems, system of systems, robotics, power and energy, critical supply chains, intelligent connectivity and compute, including future of quantum and AI chipsets, as well as in biotech, mainly focused in engineering, biology, and biomanufacturing. Cybersecurity too, sorry, left out.
That's great. And I want to, last but not least, Chris Olson, who I've known from your Sequoia days before you decamped to the middle of the country. Chris, flip it over to you.
Sure. So I'm Chris Olson, the founder and CEO here at Drive. We are a $2 billion investment firm based in Columbus, Ohio. And we have offices and now 6 offices across the country, really primarily focusing on bringing Bay Area venture level services to founders in the rest of the country, in the majority of the country. We invest throughout the entire continuum. We do everything from 500K seed checks on the venture side, on the seed formation side, all the way up to $200 million growth rounds that we're leading and participating in. So have had the chance to really prove out this idea that incredible companies are being built across the totality of America.
Great. Thanks so much, Chris. Eric, I'm going to flip over to you the first question, and we'll sort of try to keep this interactive. Obviously, if the audience has questions, feel free to use the chat, and we'll try to pick up on those questions along the way. We should go about 45 minutes in our overall discussion. Eric, I mean, it's hard to start a conversation about what's going on in the market without escaping the reality of AI, right? So I figured we'll start with the big elephant in the room. And again, maybe you could talk about how you and GV have been thinking about AI of late.
Yeah, obviously AI is sort of dominating the conversation right now. At GV, we feel like we've been investing in AI for the better part of a decade. And obviously things have really accelerated over the last several years. And we break down AI into basically 2 categories. We think about with AI and for AI. And with AI is companies that are using, existing foundation models or LLMs to improve workflows. And that can be across a number of different verticals, everything from, legal, sales, medicine, accounting, marketing. I mean, the list goes on. And we have a number of different bets in companies that are doing that. And again, they are taking these models, bringing in their own data, their own workflows, and then solving real customer needs. And that's resulting in some tremendous growth. The other side of it is, for AI, this is all the stuff kind of beneath the surface that's powering these incredible tools. And we think about this from the silicon layer up. One of the companies that I've been involved with now for several years is Light Matter. They have built chips that communicate using photons instead of electrons. And, that's great in terms of lowering the amount of energy that's needed and improving bandwidth and kind of connectivity between, GPUs or different types of chips. And it's really like these are the types of companies building the breakthroughs that then allows us to build bigger clusters, train bigger models, and then drive bigger outcomes for the ultimate users of those. But certainly, it's fair to say that AI is kind of dominating a lot of the entrepreneurial conversations we're having these days.
And dominating may be an understatement. I mean, at 50 to 60% of deal funding flowing to AI, it's quite extraordinary, actually. And you can slice and dice the numbers any way you want. You always land in that zone, which is incredible. John, you guys, as you mentioned, have a focus on national security globally. What's the intersection of AI and national security and your investment thesis more generally?
Yeah, like Eric mentioned, we've been investing, it feels like, in AI for a long time, as well as with the secure supply chain to be able to deliver the capabilities in sort of a global competitive environment. So in terms of the government intersect, it's really about the broader shift of analyzing, the speed of data, how quickly you can make data and certain insights actionable. Not just simply the training of large language models, because many government applications also involve moving AI to the edge. So there could be other deployments outside of a centralized data center, and being able to secure AI applications and the infrastructure behind it, as well as to ensure reliability. So how do you check for multiple AI agents that could be coordinating? How are you going to validate an agent that acts independently and autonomously in the future? How does AI start to drive speed and resilience if you can't also trust and you go back to be able to understand where the training data came from? How have you built a model that you can rely upon? So many of these areas are driving our government partners into use of technologies that they hadn't been as familiar with before, but are rapidly moving towards trying to harness the capabilities, much like all commercial customers are moving quite quickly.
And Chris, I want to flip back at you because I'm always intrigued by your investment thesis. You mentioned that you're in, of course, your founding office is in Ohio. You look to the middle of the country, broadly defined. How are you seeing things again from the Hudson River over to the Rockies and north, if you will?
Yeah, I mean, I think right now what's going on is most people they're scared, if I'm being totally honest. Like if you were to go meet with your average corporation, they're not exactly chomping at the bit to adopt and put these technologies into production. But I think they all recognize that the amount of just sheer investment that's gone into training and building and creating these technologies has dramatically dropped the cost of finding a way to apply them to whatever it is, whether I'm a hospital and I'm using this to send bills, or I'm an insurance company and I'm using this to process claims, or whatever the thing is. And I think what we've really found is an interesting, cross section here is being able to be, almost like a forward deployed engineer, where I think of like Palantir has done an incredible job of being a forward deployed engineer into government contracts and helping the government and the DoD understand, like, how do I get my engineers close enough to these real world problems, and then bring this knowledge set of what can technology do to kind of be that bridge between these things. And when we've been able to do that, I think we've been able to find incredible economic and potential, and in the form of mostly in revenue adoption. So, a great example would be that a decade ago, to train an AI to do a manufacturing task, it just would have been off the table. It's just too cost prohibitive. And if you were to go around to most manufacturers in America and be like, what would you like for AI? They'd be like, I'm not interested. Like, that's not my problem is not like, what do I spend AI on? My problem is I'm trying to hire welders and there's a shortage of welders, or I'm trying to, facilitate the assembly of products and there's no way to do these things. And so, we have a company that's been solving that with welding in particular, and they go in and they sell welders. The welders get hired. And there's tons of AI and there's tons of computer vision that goes into it, but the end customer doesn't really care. They just know that if they're able to hire these welders, to give you an example, one of their customers processes 70,000 with their welding army of humans. They process 70,000 inches a month of welds. One machine does 70,000 inches a day. He's able to 30x his productivity. He's in the shipbuilding space, and he's now able to process a much larger backlog of contracts that he's not been able to get to enable the next generation production of ships and things like that. And I think that so our success has been really being that bridge and helping people understand AI is not this thing that everyone should be afraid of is going to take your job. It's quite the opposite. It can really be a productivity enhancement when it's put into the right place, but it's hard to find those spots.
John, you seem to be concurring. I wanted to sort of just again bring it back to the defense tech, national security side as well, in terms of again how not just AI but beyond AI in terms of what's intriguing you in market. And I'm kind of thinking about it through the prism of what we're seeing again in the Ukraine Russian skirmish or battle war, whatever you want to call it right now. Again, just want to open it up to you on that ground.
Yeah, so let me just I'll transition concurring with Chris. You're right. We're this month highlighting strategic industrialization as a theme, in many activities off our website. There are AIs that are coming into the production and sort of the enhanced capability of reindustrialization in America, how you're going to better produce products. To that lens, then, if you took it to Ukraine, Victor, you're asking about, first a caveat, it's sad that there's war that has to bring us lessons in terms of where some of these technologies are applicable. But the leaps that have been able to go forward in terms of the speed and processing of information, how it needs to be, how it can be utilized, autonomous systems in general. So both physical AI that Chris was speaking of before, but also drones, robotic systems that are out in the battlefield that are being actually enhanced rapidly in iterative startup teams, as it were. It would seem like not a major industrial base that's producing these capabilities and systems, and they're fielding and being able to be utilized very well. Also, where drone swarms are being able to be used, AI and autonomy now giving the capability to potentially manage many different autonomous actors and systems. So one person controlling many is a brand new dynamic. And it's shown us that the pace at which innovation can drive when you have edge cases, the areas where AI is meeting another area of robotics. Many times the most fertile grounds for development of new ventures are at these edge positions, not just a central market theme, but where one sort of crosses over to another, there's a lot of value unlocked. We're seeing in the Ukraine example, many technologies driving that way. Also in cybersecurity, how you have to be able to handle information, analyze it more quickly. Remember that combat is not just kinetic these days, it's also about information. So there are many things that have to be driven in that direction too, with just the speed of change that is dynamic. I think there's a huge value creation being proven out there. It's also translating to the value creation that we see here domestically and around the world from both commercial and government use cases in general.
John, just staying with cyber, I just want to focus on that a little more, tease it out. Can you talk to any of your innovative portfolio company opportunities that you've invested in?
Yeah, like one in particular, I mentioned, Volncheck, transforming vulnerability feeds into a dynamic, exploitative, aware environment. AI trying to interpret a lot of different types of feeds, but becoming a commercial grade alternative to what we already have as a national vulnerability database. So how do you keep up with the pace of change around dynamic threats that are existing in cybersecurity? We need companies like Volncheck that can very quickly tailor a product for both commercial application and for government. And they did so once after our investment, in about a year, really had the ability to connect the company with government and begin to build out a product that has driven to government adoption and now is a mission-ready cyber tool. So that's really about our investment model. If we can bring capabilities like that, guide them with government potentially as a design partner to understand the qualifications and potentially some customizations necessary to be an effective adopted product, our North Star is to translate those capabilities to become an adoption by government over time.
Eric, I'm going to swing back to you, just pull you back into this part of the conversation. I know you're focus generally, as we've talked about, is AI, sustainability. I just want to come back to cyber. Are you guys playing in cyber as well? You must.
Yeah, I mean, cyber has been a big theme for us also for several years. We're early investors in companies like Duo and like introducing multi-factor security. I think today, the frontier of cyber for us is with LLMs as they're being adopted by many different organizations. It just creates a different security challenge. Like you're worried about, information being leaked. You're worried about risk in terms of both external people maybe using an LLM you've deployed, or even people inside the enterprise. Are they able to use the right capabilities? Does the permissioning scheme make sense? There are some worlds where if you're pulling in data from all across the enterprise, the CEO is the only one who would have access to what they're seeing. So there are all these types of challenges that both enterprises and other organizations are dealing with. We have one investment in a company called Witness AI, which is really helping companies just even understand how LLMs are being used, which is the first step, obviously, in terms of implementing, really good security. And this has really been a big theme for us, I'd say, beyond cyber, is like what are the second order effects of all of these LLMs being adopted? Because it's going to create these other sorts of bottlenecks, whether it's in terms of security or other threats. And we feel like there's a ton of kind of untapped entrepreneurial energy that can go and like solve those issues today.
It will go without saying that, and I want to hit on the second theme I was alluding to, Eric, with you, which is sustainability. Obviously, given the use of power or the requirements of power as it relates to AI, it can be extraordinary. I want to just spend a few minutes talking about, again, another area that's attracting quite a significant amount of investment across the gamut here. Again, what is your thinking about sustainability, and why are you focused on it as a fund?
No, thanks, Victor. I mean, I think sustainability is important for lots of different reasons, and I think it's actually a place where there's still a lot of great opportunities. I think AI has obviously caused a huge demand for electrical generation. That's going to put a lot of strain on the grid, but there's a lot of solutions that we can put out today in order to make the grid more smart, more resilient, and just set up for kind of the 21st century economy. We've placed a bunch of different bets there, everything from software in the company Scope 3 that helps companies just kind of measure emissions in terms of how, created from everything from digital operations on down, that helps with just understanding their own footprint and their resilience. We're in a company, Gravity, which is actually a really interesting EV charging company that's grid friendly. They've built what is the fastest EV charger in North America with charge times that can get as low as single digit minutes. So we're approaching kind of like gas station speed, which is what we all really need. But at the same time, all the infrastructure behind that is designed to be really helpful to the grid. If it's neutral or better. If we see EV adoption pick up in the way that we all hope it will, that might be as big of a kind of consumer of electricity as some of these AI build-outs. So there's so much demand coming to the grid, and so we need all these new participants to be smart, to make use of kind of new clean energy generation, and hopefully there's a whole new breed of entrepreneurs that we're looking for to help just build out all that infrastructure.
Yeah, Chris, I want to pose the same question to you, just to tease out again from your perspective, not just limited to the Midwest, but beyond. Again, what is your thinking in terms of need to invest in sustainability, energy, et cetera?
Maybe controversial to say this, but we're not focused on it right now. I think that the challenges of investing in that space is it drives an enormous amount of capital intensity, and just given the model for venture returns and the cost of capital, like we've never been able to make those two curves really intersect. I feel like it's a space. I've been in venture for 20 years. We've been looking at it for a long time. It's just a really, really, really hard place to justify the venture cost of capital, especially when the opportunity cost of not investing in lower capital intensive areas that have higher potential for return are that much more attractive. And when we go to market, our LPs measure us against the performance of that capital against any other asset on planet Earth. And so if we're not mindful of this, then we'll fall behind our peers, and we won't be able to raise additional funds. So there's an economic incentive and sustainability of drive that is really driven by the overall performance that we need to find those capital efficient places to do it. And we've not seen it develop in the sustainability realm.
And you don't seem, I'm surprised that the utilities aren't playing a more active role to sort of bring, additional strategic capital to the table that would make it more attractive for the venture community to get in.
I think it's just, I think it's for the venture community, we have 10 to 15 year lifespans. I think utilities are thinking about this over, 30, 50 years. There's a very different cost of capital that kind of goes into green lighting a production facility if you're a utility to it, and they're measured to like, an inflation plus like 200 bips. If they can do that, then they're successful. We've got to come up with 25% net IRRs. To do that, it's just it's not feasible to be able to do those kinds of things and have that same kind of time horizon. So we just haven't seen it be a primary focus area, other than them being, a very large customer segment to potentially sell these technologies into.
Victor, can I double click on that for a sec too?
Yeah, I want you guys to
Because,
double click on you for that.
Yeah, I mean, and I know Chris has an excellent investment practice and background, so I only commend where he targets his thesis. He is right in the sense that, look, hard tech and frontier tech does take some specialization of resource. I know we've seen both the venture return as well as the challenges of some of the capitalization needs for some of these segments. Eric alluded to energy generation. There's also issues in distribution and storage. Strategically, we're certainly looking at the need to have to make the grid more resilient that I know Eric had brought up before, where there's a series of technologies. You also have to take a tech landscape approach to think about where the opportunities are that can drive towards a future of electrification and support also these AI needs that we spoke of, earlier. In those areas, there's new generation techniques, of course, around fusion and fission and small modular reactors that have not just applications domestically, but about how you can deploy energy to different sites around the world. And then there's important elements of next generation storage, solid state, greater energy density that can be in things that drive many portions of our economy, and not just the grid as well. So you're talking about the ability to have eventually vehicles that may be able to powered more by electric, aircrafts and drones and boats that could be powered more by electric as well. Not just for an emissions standpoint either, but for the efficiency of how these and reliability of how these systems can operate as well. Because you're dealing with then simpler drive systems than an internal combustion engine. They have a lot of smart applications in logistics applications, travel, and moving people, as well as the ability to, you think about how much goods and services move around the country through long haul trucking and train, et cetera, that there need to be better systems that can be electrified over time. It'll make us a more resilient economy at whole.
Yeah, again, John, I always tend to think about it through, again, some of this and through the prism again of what's going on in Europe, in Ukraine in particular, where you're thinking about dispersed energy production and generation, which would help Ukraine. I think of
any of us watching the reports of things coming in, you realize there are targets of energy producing and energy distribution sites when a country's being attacked. Those attacks, though, aren't always kinetic. They're not always an explosive device coming. These days, when we talked about AI and the intersect back to energy and the resilience of the grid, you have new exposures in terms of if a system can be penetrated, how it's being developed and engineered to be run and sort of optimized by AI systems as well. And there's a new opportunity for growth each time, but there's a new vulnerability too. So you have to be able to invest in the resiliency of those different types of systems. And so sometimes you think of that being hardware and power and generators in a sense, but sometimes these are information systems that also the advancements are made in that actually are then lay as the foundation to drive a more efficient data center. The $2.8 trillion that's going to be spent in, say, the next 4-5 years by different analyst estimates that are there to be able to then need to drive and have the energy demand to actually keep up with the AI demand and development that we've been speaking of earlier too.
Well, I want to pivot if I could. A really interesting conversation, folks. I appreciate your thoughts on so far. But I want to pivot a little to pricing and what's been going on in market. Obviously, there's been venture markets are down. They're sort of starting to pick up. Certain areas, though, were not down. And I suppose, Eric, just coming to you, why are valuations in AI so high? Obviously, there's some blockbuster deals that are attracting attention, but I think across the sector, there's some more frothiness that you don't see in other sectors that are lucky enough to get venture capital invested in them. So just a couple of observations from your side, if you would, and I want to flip over to the others.
Yeah, yeah, absolutely. I mean, I think obviously there's a lot of excitement from LPs on down for all things AI. I mean, we see what's happening in the stock market. And part of this is, again, when we're seeing early stage companies in AI, what's I guess what's different versus, other, new technologies that are being introduced is just the time to value and the ramp of that revenue is really, really significant. In previous cycles, there's been lots of excitement around, new types of technology, whether it's cloud, mobile, the internet itself. Typically those cycles came with a lot of excitement and then the revenue sort of followed. I think what's been really exciting about AI is that companies that are, quite young have, are getting to 10, 20, 50, $100 million revenue rates in record time. And that's partially because, AI is often replacing, labor and sometimes expensive labor, or it's augmenting people to be 50% more productive, right? And then you can put a real price on that. And so it's a very different type of ramp. I think what's the uncertainty is that these companies are very young and like, will that revenue continue to grow at that rate? Does it flatten out? Like, what are the long-term margins? Like, these are all, I think unanswered questions for many of these businesses, but at least at the kind of like acceleration piece of it, it's tremendous, and the companies are definitely being rewarded with handsome valuations. But in many ways, it's kind of less frothy than previous eras because there is real revenue and there's real customers, and they're getting value from these companies and services today. I think maybe the other side of the coin is things that are not AI. It's that much more challenging, potentially to get financings, especially if the growth, isn't as spectacular as with some of these AI businesses. It's no longer as shiny. I think there's still lots of great opportunities to deploy capital outside of core AI. But again, you're now being compared to some of these really, fast growing and scaling companies.
So, Chris, just again, almost the same question again. What are you seeing in terms of valuations in your neck of the woods and in where you're investing in particular?
So I think it's a scary time right now in venture. Like LP commits to venture went from their peak of $200 billion a year back in 2022 to being on pace to be, almost a multi-decade low this year, probably of below 50 billion. So you're seeing LP funding to VCs down 75%. And I think that's a really important stat for everyone to kind of grok, because I do think it drives the behavior of what you're seeing happen, where all 40% of all venture dollars in 2025 have gone to 10 deals. What does that tell you? That is venture capital. That should be like the translation to me is I am flocking to safety. I am not going to I'd rather back a well-known name that my peers are all backing too, than take a risk on a new company that that my peers are less familiar with. And you're seeing it drive an enormous amount of equity value ahead of financial fundamentals that I think is unsustainable, right? Like, and it's happening in the public markets too, right? The Magnificent Seven there's no fundamental justification for the multiples that these companies are trading at right now. And if you take them out of the equation, overall equities have not kept up with this. But I think as this trickles into the venture world, what it is doing is you're seeing headlines that are driving what feel like very attractive valuations, but they're not driving the distributions that LPs need to then take the capital and put it back into the puzzle, right? You're seeing maybe some IPOs now, but those distributions haven't happened yet because the lockups are just starting to come off. So I think that what you find is that the majority of companies are really struggling to access follow-on capital. Now, I don't know that that's necessarily a terrible thing, because I think some of the best businesses I've seen in my entire career are coming out of this because there's no other choice. You've got to get to cash flow positive capabilities on a very, very small amount of money. And I've seen the best business in my entire career is a company we're investors in right now. This business is doing over $100 million of revenue a quarter. They're doing 90% free cash flow margins and growing 400% a year. Like, this is a phenomenal business, and is not in any of the headlines. Has not raised money this year. People don't know anything about it. It's just like a lesser known company. I think what will come out of this will be the same that we saw when when the telecom boom happened, when the internet boom happened. Like, I've seen this story play out, is that you'll see the headline grabbing stories eventually fade away, and a large number of companies will fail and a small number of companies will emerge to be the most important businesses of tomorrow. But I think it is a very challenging time for founders raising follow-on capital, because the venture firms are out of money because the LPs are out of liquidity.
It's sort of interesting, actually, just to stay with that for a second. Not only do we have your stat that we talk about in terms of the 10 largest deals representing 40+% of VC activity. A similar stat is the top 10 funds have accounted for 40% of commitments. Sort of interesting. And a lot of our clients are emerging managers, and they're there's a squeeze going on with emerging managers in this market. I presume more pronounced than more established funds, such as all of you. Any reaction as to, maybe Chris, just to finish up the point on, I want to just focus a little on what you're seeing with emerging managers, and are they bearing the brunt of what you just described more so than others?
For sure. I mean, it's a train wreck right now. If you're out raising a venture fund, if you don't think like, when I meet my peers and they're like, venture, fundraising is not hard right now. I'm like, this is like the classic example of the market's down 75%, but the value of my home isn't, right? Like, give me a break. Like, I just don't believe it. And I think the reality is, you have to remember, like, how does a venture firm go out of business? Like, there's not going to be, these are 10-year subscription revenue streams, right? So they're not going to go away like a startup will go away and just vanish and put up close. Like, they keep their websites up, they're doing, so it's not obvious how many of them are in fact going out of business. Like, we've seen some of the headlines with OpenView or a handful of others, but most of them are just they're just gonna stay there. So it's not gonna be obvious what's going on. But when I talk to my friends who are emerging managers, they describe a very, very challenging environment, like an impossibility to raise funds. And even established firms, you're seeing take 2 years to raise funds that are half the size that they were of their prior vintages. Like, it's a really tough market out there, for sure.
John,
LPs need to be able to manage the liquidity cycle. And what Chris was mentioning before in terms of the system dynamic and challenge of not as much fundraising by new VC by VC managers in general, and then I'll get to emerging managers in a second. In the mid 24, later 24, we hit the global high of dry powder that was actually in the private equity venture capital industry. It was like over 2.6 trillion of dry powder that was invested. So part of the issue is that LPs are on the hook for commitments that go forward without that liquidity that's coming back from companies exiting at the same pace that they were several years ago before the pandemic. The result is, of course, that LPs become much more selective. And I know Chris now has raised multiple funds, which is a great accomplishment by any background. But emerging manager in our business often sometimes is talked about as almost a fund 3. So somehow you have to get across the chasm of raising the first and the second to get to the third to actually qualify for a lot of the mainstream LP fund to fund and the highest end endowments that want to participate. There are exception stories, but I too have heard of many different firms that are on somewhere between fund 1 and fund 3 that are having a real hard time getting challenged to get commitments and to even get what we all know is sort of that first anchor commitment from a very large, well-known LP that others may be willing to follow, because a lot of them are slow in the market to try to look for those opportunities. When venture capital was expanding at such a greater pace, about 3-4 years ago, there was almost a drive by LPs that had to find new managers because they couldn't put more money to work at the same time in the funds they were already invested in. They're only growing at a certain pace. They couldn't increase their capacity. They were very high in demand for all those top performers. The emerging managers provide the new ground, for that growth. And it's really important catalyst within the overall venture ecosystem.
So John, I want to come back at you just to follow up on that. Just if you look at the overall liquidity, and maybe I'm weaving in some of Chris's points as well, just looking at the whole chain of, there's a lack of distributions to limiteds. I want to just talk about IPOs and M&A, which explains some of the gridlock. Chris calls it a train wreck. I'll just call it gridlock. Talk to me about that a little more in terms of the IPO market, M&A, exits, etc.
So we've recently seen a breath of fresh air of some tech IPOs being able to come to market, and they've actually had pretty good initial trading across the board. But we have seen M&A sort of bifurcate, where some of the largest players who have the greatest cash depth are actually taking on larger acquisitions, and some of the smaller ones are not moving at the same pace as they used to. The result is that the venture funds are not bringing back in the realizations to make the distributions back out to LPs. So if we have other entrepreneurs on the line, just to translate that into one of the other points Chris made, the investors have to become more conservative in this period. You're looking for things that you can make a little bit longer term bet on, both because of what you see as the economy is hopefully recovering globally since the pandemic, but you need to make bigger bets on things that are moving into larger dynamics, which is why AI has probably attracted so much attention. So Victor, with that cautious environment, remember that in most venture funds, averagely speaking, say 6%, 4 to 6% of deals actually end up in IPO. So most venture-backed exits are going to be in the M&A space, and you actually have to build companies, intelligently, thinking about how they're actually going to be in acquisitive ecosystems and be able to drive strategic value at the end. That's what Eric, Chris, and peers are good at. And that's what they have to be good at in order to both select the companies and then add value to them in their growth. And these are the sort of important dynamics that are right now still spurring the industry. While we had that breath of fresh air, there's now other challenges that are going on. Some of them are policy driven, some of them are global economically driven, that are sort of putting a tamper on whether we can get a lot of the IPOs coming out. And there's a huge backlog of private companies that have been raising funds at over $1 billion valuations, multiple hundreds of them, that many are qualified potentially to come to the public market, but have been raising such large sums of money, not just those in AI we spoke of a moment ago in that concentration, that are actually staying private longer, and they need to in order to wait out the environment to get better for them to be able to come out. So there's a large backlog. So the companies that are good but not great, not outstanding off the charts, they can't access the public market in this environment and won't be able to until that backlog's cleared out. Back to the point of entrepreneurs need to be able to build for companies that really are deriving strategic value, where other commercial enterprises are going to want to acquire them, and they can deliver something that's accretive to the bottom line of a much larger company too.
So great points. I want to unpack a few things you just mentioned and ask the other panelists to jump in here. Maybe Chris, I can ask you to jump in here to start. Just in terms of, being in a leadership in a challenging environment where there's no open spigot. What do you expect of your founders? Like, and what is a strong leader in your mind of a portfolio company look like? Um, so Chris, let me flip that to you. I want to spend a little time there.
Sure. I think it's, the utmost important is that you've got to focus on like the real metrics that matter. And you've got to remind yourself that the investors that John was describing in the public markets, these are some of the shrewdest people in the world. Like they get it. And they're not going, that's why you're gonna find that. I always tell our companies, like you're going to find that the challenge of raising a fallen round is hard, but the challenge of exiting a company is, you're talking about like multiple orders of magnitude more challenge. And so I think a lot of our founders who were great fundraisers, that was a one tool successful CEO that actually worked in a 0% interest rate environment, because you could just keep raising, keep raising, keep raising. That is gone as a skill set. Like what really matters are founders who are able to understand. What I'm here to do is I'm here to change the lives of my customers. And I'm going to show you what metric matters most to them, and it can be different. For some in an enterprise space, it'll be an ROI. For a consumer, it will be that they're adopting something that they never had before and they can't go back. There's a change of behavior that's there. But it's got to go all the way from being not just a great technology, not just a great product, not just a great business model. You've got to have founders who can build the totality into what is a great company, and has the ability to eventually tell a story around how their value proposition to their end customers is strong enough that they can charge enough to generate some amount of gross profit and income to eventually get there. That is a way harder challenge. Like it's just so much harder to be able to build something that has that compelling capability versus where we were, to do a demo of software in the cloud, 5 years ago was enough to say vertical SaaS, give me, I'll raise 50 and 500, please. Like those days are now gone. So I think we want those founders they're hyper realistic. We want the founders they're hyper transparent with their teams, because they're willing to stand in the light of how hard it is to do these things. They ask for help. That'd be a big one that we're seeing, across the portfolio. Like how many of our founders call now and say, I got a problem, is actually a really important skill for founders today. And I think lastly, we want people who are capable of judging the capital risk continuum inside of their business in a way that's appropriate with a much more managed burn. And I think that those are it's pretty fundamentals based stuff that we're seeing be most successful.
So Eric, if you've got a founder that's an evangelizer, who can articulate the need for a great new idea in a market. You've got someone, as Chris just talked about, in terms of in the old days, somebody who can just keep raising money. But then you got the guy who actually can build a business. I mean, which and grow a business and be operationally oriented. I mean, are you leaning towards box number 3 or door number 3? You need them all. When you're sitting down with that founder, what is her profile that you're thinking hard about?
Yeah, I mean, I think, especially, if we're on the subject of exits, I think the leaders of the company need to check all the boxes right now, whether that's inside of one human or inside a founding team. They need to be able to execute on a business, be an amazing storyteller, and usually for most of the businesses we're working with, there has to be some, profound kind of technical or, operational experience that helps, drive them forward and innovate, and keep them ahead of all the competition. So I think that, based on the stage that we're entering, like there might be a little bit more, there might be more degrees of freedom, just given, if we're coming at the earliest stages. but ultimately for a company to be successful and certainly drive something as far as an IPO or some large scale M&A, that team is going to have to be exceptional probably in all of those areas. And, often, again, we're spending a lot of time with engineers and researchers and people that are, leaving interesting places and sometimes just starting their entrepreneurial journey. We're looking for people that have, incredible technical credentials, but also are amazing, storytellers and, are able to pitch, right? They're able to either pitch to get capital, pitch to get customers, pitch to get employees. I mean, that's a skill that's kind of universal, I think, in terms of, the entrepreneurs that we're most excited about backing with our capital. So ultimately, the team's going to have to, check every box, but in the beginning, you might have a few weaknesses, and then you're gonna, hopefully be able to grow as the company and the business expands.
So, John, just to focus a little more, since you got me thinking about this line of questioning, the team do you need an all encompassing CEO, or can you in fact make up for deficiencies by having a stronger management team around you? Maybe it depends on stage of development, maybe not. What are your thinkings on what that team is?
Well, I think it's great that we're focusing on people because they really are the value engine. So not just in the high growth companies that are about driving, and being able to operate. And there you do need very specific skill sets in a CEO as you reach that type of stage. But in the earlier and emergent growth stages, you can have CEOs with different backgrounds and also personality types. You do need the self-awareness, though. Chris made a really good point before, the CEO that asks for help. You like to think that if you're a good investor in building a trusted relationship, you're not just getting a phone call about good news, you're an early phone call when there's bad news or something challenging going on as well. If a CEO is self-aware, I think they can build an effective team around them and potentially where they might have an area that's more deficient, bring in and basically be able to delegate to others. But back to that ability to pitch that Eric said a moment ago, you have to be very evangelistic to get people that want to join your venture. In addition to raising capital, people vote for ventures with their feet, whether they jump in or not. CEOs have to be effective at that quality to be able to get people to join in. So while you can supplement it, Victor, there's really no substitute for people that have vision, that can motivate and evangelize to others, and that can also be effective leaders. Multiple areas of what you need to do through the different stages of growth, though, do require changes, and sometimes people do outgrow their core skill set and sometimes need to cede the chair to somebody else over time. I'd like to think that I know career-wise, and I'm sure my peers have done the same, you really can build successful ventures around different types. Those that have not led before formally and led a venture, and those who have done it multiple times. Sometimes the ability to not be constrained by something you realize, I just don't want to make that mistake again and this mistake again. You sometimes don't have the vision to jump for a bigger opportunity and ask the question, well, why not? Why can't we do this potentially? Other times when you're trying to hit that company, Chris mentioned before, 400% growth per year and do it for multiple years in a row, you have to be a great operator to know how you're going to want to structure your organization to behave and continue to deliver that type of growth. And that's not easy to do if you've never had that experience before, when you're now growing to multiple hundred or multiple thousands of employees, and how you drive an enterprise that's large. So I think that you need the flexibility, Victor, to recognize in different markets and sectors that these profiles do shift a bit at times. In the end, though, you do need the people to be the lead. Ahead of even the scale, we need the three things. We need scale of market opportunity, we need competitive differentiation and competitive advantage that's sustainable, and we need people that know when to take the particular pivots to drive a company towards greater value. These ventures do not build in a linear fashion. They are not just charts that go up and to the right only in a straight line. They take a community of investors, other independent board members, and the strength of the management team to really lead these ventures forward into success.
Great point. And by the way, in years past, what we've seen is one of the great challenges of building and running a company is attraction and retention of talent, right? A lot of, especially on the coast, we saw a lot of jumping around. People weren't even waiting for their cliff to vest before they jumped to the next opportunity, given the opportunity, given the valuations, et cetera, et cetera. What are you seeing now? Are you seeing, and by the way, the middle of the country was always viewed as a more stable environment to grow a company because talent was not jumping around all the time. What are we seeing right now in the marketplace, the tech labor market, if you will? Eric, you want to jump in there, or Chris? Or, I mean, John, keep going, right?
Go ahead, Eric.
Yeah. I mean, I think in terms of the tech labor market, like it's really interesting, right? Because I'm sure we've all seen the headlines where, at some end, people are being paid, insane sums for a very specific set of skills. And at the other end, there's been a lot of like layoffs. I think there's the highest unemployment for like new computer science graduates in many, many decades. And so I think this kind of bifurcation of the market is really tricky. We have companies that are struggling to hire fast enough, and we have companies where they're just being inundated with applications. So it's tricky because just it goes down to the specific skills that are out there, and that could be very hot ones like AI, or maybe less hot ones for other categories. So I feel like it's hard to speak in like broad terms about the job market, but we are seeing, like, again, some of the most sought after skills. It's like very, very, very hard to fill those, even if you have a lot of funding, a great company, growth, and everything else. And I think for other companies, they're figuring out how to become more efficient, and they don't, they maybe have way more talent supply than is required. And as they are adopting, more tools or more automation or more AI, their companies are becoming more efficient, and talent is not the thing. It's no longer the limiting factor in terms of them continuing to expand or continuing to become more productive.
Chris or John, want to rejoinder to that?
Chris, you want to hop in and give a perspective from the
Sure.
middle
I
country?
think,
I'll
I
add one
think,
there.
I mean, look, I think that remote work has enabled a recruiting capability that was previously much, much harder to tap into. And I think that, like, that's made some of the more traditional markets just less compelling places for certain talent pools. But I think that, in general, in markets like these where you're finding that the quantity of jobs that are out there on the market is smaller, the employers are choosier, and it is definitely a harder time for companies to, or for employees to have the same labor liquidity that they had in a more buoyant market. But it's just, I think it's just a different skill set of building teams in this environment compared to where we were maybe a few years ago.
Yeah, I think if I put just a quick lens on things that cut across frontier tech, deep tech, and things that have a great impact on national security, we're talking about a lot of different types of companies and a lot of different types of tough tech that's being built as well. It is absolutely clear through the lens of the many hundreds of active portfolio we have currently that data scientists, those with skills in AI, machine learning, are in high demand. But the companies that are landing them have not just growth trajectories, but they're doing things that are important, and they have an important mission. And I think that especially those in their 20s into their early 30s, sort of a very growth portion of everyone's career, you're seeing that generation really being driven towards both that they want to have an economic outcome, and they want to feel really good about the mission that they're joining, and that they have a connectivity to it. Back to the people and the leaders of those enterprises, they're doing a good job of being able to not just execute on their business, but be able to take that story out to people that want to join these types of ventures. And it's an important characteristic. So across the spectrum, we see those that are still doing well in hiring have that characteristic. And we see the job seekers are looking for a portion of that too.
It's pretty profound. I think that we've seen that actually in the biotech, life sciences, med tech area as well, where people consistently walk away saying, hey, I helped cure X, or I helped contribute to Y, and whatever that Y or X happened to be. So I think that's a great point. Hey, we're top of the hour just about. We got a couple more minutes. I just wanted to pose a final question to each of you. We'll do a disservice to it just because we don't have a lot of time. But I wanted you to sort of just give me some insight as to what your boards or your management teams are most concerned about from an external macroeconomic or political perspective, if you will. Like, what keeps them up at night worrying about impacts on their business? again, in terms of what's going on beyond the immediate core of their businesses. Um, Eric, I don't know if you want to just jump in there, and again, take the question any way you want.
Yeah, I mean, I think we just work across such a broad set of companies. Like it's hard to think of one theme that's sort of dominant. I think, really part of it is velocity. I think that's really, again, thinking again about all of our kind of companies working in and around AI, there's a real sense that, the world is going to change in the next 6, 12, 18 months. And being first, or being, at least in front of customers quickly with working solutions, like that door is closing. So there's a lot of companies that are just going through tremendous lengths. Again, we've talked about hiring, raising capital. Like how do you kind of get the sort of perfect storm of all these things coming together so that you can start to meet the needs of customers in new ways, customers and consumers. So I think that there's just this different sense of urgency that I felt in a lot of board meetings that maybe, wasn't there a few years ago. I mean, obviously in a startup, you're always trying to move at warp speed, but it maybe feels even more intense now, just because I think it's, abundantly obvious we're at this like pivotal change in our industry, and nobody wants to, feel left behind as that's kind of ongoing. And then in certain
John,
that
oh, go ahead.
No, I was just going to say that for companies that have been around for a while, like, let's say companies that are not directly involved in that, the pressure is kind of the inverse, right? It's like, how do we adopt this stuff so that we are as productive and as efficient as possible? And there's a mandate, and I'm sure we've all heard of these mandates kind of being implemented with varying degrees of success, but everyone understands that it's kind of adapt to this new world, build a more efficient company, or risk being lapped by an upstart that doesn't have the baggage of not having built a company in this way. So I really think that if you're a founder now, at the earliest stages of a company, like it's probably the best time ever to be a founder, because the things that you can accomplish on limited capital, just with your own kind of creativity, and maybe a few people around you, is incredible. You can discover product market fit. I mean, you can even get lots of revenue without ever meeting a VC. I mean, that's just an incredible moment. And so I think that explosion of creativity is causing people to want to move extremely fast, or to, make sure that upstart isn't somehow disrupting, an existing business.
So last word, John or Chris, again, just trying to tease out whether anything happening in Washington, or whether it's policy driven, it's tariffs, it's this, it's that, is that driving any of your company's concerns around the table? And again, we're out of time, but just 30 seconds.
Yeah, I think in short, there's still some global economic uncertainty. And much like we thought about the back end of the pandemic sort of being a K-shaped recovery where people had different experiences, even though we both came out of it, some people did pretty well actually coming out as markets recovered. Others were struggling. I think we're seeing that in companies and the boards that we represent too. As each of the Chris and Eric have already mentioned, there's a moment right now where companies are doing pretty well, but aren't accelerating at sort of an explosive pace, are facing new challenge. And boards are talking about how to be more conservative with cash, the struggle that those types of companies may have in raising more capital. How much more quickly do they have to get to be able to manage their own profitability in the future? And you're seeing a different experience with some that are actually starting to go fast, that maybe came out of the background of the past few years, about wondering, should we step on the accelerator? And boards are having a lot of conversation of, yes, we actually do need to go faster. We have to have the confidence you're going to be able to access the capital market and grow that business and be one of the first movers in a new greenfield space as well. So I think that K-shape is part of the experience.
Chris, any closing comment? Before we close.
I think, look, I think that the line of truth for me is there's never been a better time to be a founder. Like, if there's one thing I hear a lot about, is volatility. Everything is changing. Like, I don't know what's going to happen in Washington. I don't know what's going to happen with AI. I don't know what's going to happen with interest rates, but I know it's going to change. And, that change introduces gaps in markets, and you have the window of time to fill that. And that really lends itself towards startups.
Great. Thank you all. Great conversation, fast paced, always enjoy. I gained some great insights. I hope our audience did as well. Eric, John, Chris, thanks again for your time. Have a great rest of the week.